Welcome to Colliers Talks, a podcast series featuring the latest trends, insights, research, and developments in commercial real estate in Canada and beyond.
Hello, I'm Adam Jacobs. I'm the National Head of Research for Colliers, and we have another Colliers Talks podcast today on a very hot topic, the topic of development and the debt market. We're joined by Tyler Dolan, our Managing Director in Victoria, BC, and by Jordan Carlson. Jordan's the President of Anthem Holdings Canada and the Senior Vice President of their investment group. They've got 11.5 million square feet of income-producing property, retail, office, industrial, and of course, apartments across Western Canada. Jordan's also leading the acquisition function for the entire company and works closely with their equity partners, including public pension plans and high net worth investors. So I think it's fair to say he has a lot of insight on both the in-place market and the development market. And I think there's a lot to talk about here. I'll let Tyler introduce himself. He's the head of our debt team. So a lot of insight being brought on that side too. Tyler, can I pass it to you?
Yeah, thank you. Hey, and Jordan, thanks for joining us today. I know.
Thanks for having me.
Yeah, you bet. We've dealt a bit in the past, and we've definitely had a lot of conversations about not just development in general, but also just the financing world and some of the special things that you've done that are a bit different, which is one of the things that makes Anthem unique. But before I get into that, introduce us to Anthem. Maybe describe what your company's background is and your vision.
Sure. So, yeah, absolutely. So we've been around for 30 years, over 30 years. The company was started by my dad, Eric, who's still our CEO and very, very involved in the business day to day. So really, when he started, he was buying apartment buildings in the U.S. out of the Resolution Trust, which was a big trust created to take distressed properties from the savings and loans crisis in the early 90s. And so he was buying cheap multifamily, adding value, and it kind of started there. So obviously we've been many different things over the last 30 plus years, but today we're a fully integrated real estate investment, development, and management company. We have over 800 people working primarily in Vancouver, Calgary, Edmonton, Sacramento, California, and then we opened a little Toronto office last year and plan on growing that. And then, of course, we have people on site and in property management offices and stuff like that. In terms of what we do, we have sort of three distinct real estate groups within the company, and each of those groups has underlying business units that focus more specifically on asset classes. So we do vertical development, and within that we have high rise, that's concrete, so that's to own, to rent, mixed use. We have low rise, that's anything wood frame, so that's townhomes and 4 to 6 story buildings, again, to own or to rent. And then we build some commercial. We build industrial and we build grocery anchor shopping centers. So that's development. We have an IPP group that you highlighted, 11.5 million square feet. And within that, we have a retail group that's probably, historically our most prominent asset class. It makes up, I'd say, about 7 million square feet. And then, more recently, within the last 2 years, we kind of kickstarted our industrial multi-program. So industrial, we have about 2.5 million square feet existing, with more to come to our development pipeline. And multifamily, I think we're sitting on 2,000 units today, but have about 5,000 units in the pipeline that will eventually make its way into our IPP group. And then finally, we do land and development. So that's primarily in Alberta and then California as well. And that's, big land development, buying hundreds of acres, coming up with a community vision, subdividing it, servicing it, putting in all the infrastructure and selling lots. And then we build houses as well, which is sort of a synergistic add-on to that business, both through our own account, but we have a sister company that we purchased last year called Cedar Glen in Calgary, and they sell about 300 homes a year. So that's kind of what we do. And in terms of how we do it, like I said, we're fully integrated. So it's really important us to self-perform virtually everything. So construction, property management, leasing, accounting, sourcing debt and equity. We kind of want to do that all in-house. And that's very deliberate. Development has gotten really complicated. It's challenging. It's challenging to get the right labor. It's challenging to be agile. And so we want full visibility into all parts of our business and that ability to kind of take control, make sure the right people are in place. And then, of course, because we have that many people to fulfill that strategy, we're very organizationally driven. We spend like an enormous amount of time on defining our systems and processes and our culture and our language. We need everyone to be speaking the same way, believing the same things, kind of approaching every situation with a similar mindset, just to ensure consistency of results. In terms of our vision for development, I think it's summed well by the vision for the company, which is just great space, great people, great returns, integrated through a bold culture. And so when I say bold culture, we're entrepreneurial. We try to really foster creativity, a lot of teamwork, very direct communication, respectful but direct communication. And yeah, so that's sort of us in a nutshell.
That's fantastic. Jordan, you touched on a number of those markets you're involved in, predominantly Western Canada, some in California too, which we know is, LA and whatnot's on fire. We had a discussion that Anthem's safe, which is great to hear. But when you take a look at it all, I guess the one question I'd have for you is, how would you characterize the current Lower Mainland development market?
Yeah, it's a great question, and it's a loaded question. I would say it's alluring, but it's bogged down and it's overregulated. And I say that, I think you kind of have to look back a little bit. I mean, we've always enjoyed in the Lower Mainland, an environment that's conducive to growth, just because of all the things we always talk about. Our geographical constraints. It's a nice place to live. We've got the nature, we've got oceans. You can have a good life here. And so there's always been a lot of people and capital chasing a finite supply, and that's been good. But I think 5 years ago, it's no secret that pretty much the whole world swung to sort of a left-leaning political stance. And in Canada, that really impacted the real estate market because housing was such a hot topic, and affordability and all those things. So the federal, Liberals and the BC NDP really came down hard, and I would say empowered municipalities to sort of freeze development. So you had a lot of product kind of stuck, regrouping, trying to adjust to this new world, trying to raise capital, because often it just meant it was more expensive. And now we're kind of in this position where we're still dealing with the impacts of that. And there seems to be a political leaning a little more to center. You got David Eby seems bought into the idea that supply is the way out, and he's, mandating faster approvals and, kind of blanket density around transit and all that. So that's good. Interest rates are coming down. That's good. I think activity is picking up, but we're still fighting, despite what I said about the political thing, like a daily introduction of taxes, whether it's this new flipping tax in BC, and then the big story, I think, in the Lower Mainland over the last year has been development cost charges. So despite all this rhetoric around supply, we got to get out of the way, they're making it way more expensive to build. So I think Metro Vancouver, introduced development cost charges that are seeing increases of 250% in some cases over the next 3 years. So again, we're constantly fighting margin compression and trying to make the economics work, and we're constantly retooling and having to pivot on our business plan. So it's just, it's tough, for lack of a better word.
Yeah, no, and understandable. So, I mean, Adam, jump in.
Oh, I'd say, I'm in Ontario, but certainly we hear this same discussion about development charges and maybe a little, like, a sort of lack of consistency. Like, in theory, we want more building and more development. Well, then why are we making it so complicated and expensive to build and develop if we want more of it? There just seemed to be some inconsistency there. I give BC a lot of credit, I think, for acknowledging, like, the problem and the need to do something, but it doesn't seem like it's translated maybe yet to the rubber meeting the road. I wonder if you can talk about the other side of the equation. You're looking at it from the builder landlord side of this. There's the buyer side, and it's such a complicated time right now. Like we went through the yo-yo of COVID, where it was just the most easy, favorable debt market ever. It didn't matter what the cap rate was, everything was financeable, everything was great. And now we've snapped back to a somewhat more normal situation, but it still seems like buyers are contending with a lot of uncertainty. They're maybe not ready to pull the trigger. They feel like there's more rate cuts to come, or that pricing is going to adjust. Like, how is the conversation going on the buyer side of this rather than the developer side?
And just to chime in there, Adam, just quickly, I think the pre-sales side is one that'd be one of more interest to Jordan, because we know that's always been hot in the Vancouver market. So how does
Yeah,
that
until
sit today?
recently. Yeah, I
Mhm.
mean, great question. And Adam, I would agree with everything you said, and I think it's a really good point. I think you described the yo-yo right, like well, right? I think in 2021 in Lower Mainland there was 26,000 pre-sales, which is a record, and I think in 23 it was like 14,000, and I think this year it's kind of probably going to be between 11 and 12, depending on Q4 numbers. So it has come down a lot, and some of that is there's just less launches happening. Yeah, I think we went from an environment of like 200 plus launches a year to now there's sub 100. But you're right. I mean, it's challenging for a buyer because yeah, it's not affordable. There's a lot of uncertainty. Like they're seeing all the headlines and the changes, and they're going, "What does that mean for me?" They see things like the flipping tax come in. What does that mean for me? So there's just so much hesitation there, and it's been challenging. I think there's a few bright lights. Interest rates are coming down, and I think to the government's credit, I'm not a huge, CMHC's done some things that have hurt us, which we can talk about later. But in terms of increasing that insured cap up to 1.5, I mean that's quite meaningful when you're talking about condos and longer amortizations. And BC's done a few things, so I think it'll get better. I think the one thing we have to get through over the next 6 months is there's a lot of product that was built in good times and pre-sales were hit easily. But as developers, we often hold back product. You kind of do enough
Mhm.
that you get your construction loan, and then you wait because typically it's a lot easier to sell finished product that's proven out, and you can usually get higher pricing for it. And so, I don't know that that's going to happen, and I don't know that we've actually seen that inventory come to market yet because a lot of these projects sort of need to close out their first tranche of buyers before they can really focus on the second tranche, and that's certainly the case for us. And so, I think that will stall pre-sales as we chew through that finished inventory, which I think is coming. Like it's not a ton, but it's way above the 10-year average. Like I think it's almost double, right? But the silver lining in that is as that happens, and I think prices in that segment will have to come down a bit. It'll create activity, we'll chew through it, and it'll create a bit of that psychological sort of momentum that we need. And so, we're optimistic, and that's a relative term, but relative to the past couple of years, but we're optimistic about the second half of the year getting better for sure. And 1 million people moved here in the last couple of years. A lot of them rent. As affordability comes down, will we see that shift into ownership? I think so. I think that'll be meaningful.
I would agree with you, Jordan. I think as people move here and they save up and have that ability to buy into the market, condos typically move first. So I would typically agree with that. The other thing we've noticed here in Victoria is restrictions on Airbnb.
Mhm.
I know if you take a look at that here, I think the stat I heard from Graham Smith, one of our brokers last year, was by removing Airbnb from the market, that removed 1,600 rentable units from the market for short-term rental, which is equivalent to 4 Fairmont Victoria Empress buildings. So
Yeah.
you took a look at that, you've taken 4 hotels out of the market. So, from the other point of view, not only does that impact your investors or pre-sales, but it also impacts here like the tourism market because now it just makes it a little more expensive,
Totally.
which hurts everything else. So just an interesting sidebar, and I'm sure you've seen that in Vancouver as well. Quickly, you touched on Jordan there, CMHC. And I know there's been a lot of changes in the CMHC program lately. What are the opportunities there for you as a developer?
I don't know that I have a rosy answer there, like because like I'll acknowledge I think CMHC has been a bright light. Like all the housing that's been built recently has been rental, and I think it's their programs that enable us to do that, and like mission accomplished to an extent there, so that's good. And I also get that they're they were probably on a program of let's get funding out the door, let's go, and now they're mindful of their exposure, and I think that's right. But I think the issues come down to like regardless of the change, it's just grandfathering and consultation, right? Like and so. And I know this isn't really answering your question. I'll talk about the opportunities, but I think it's important, right? Because that's that lack of grandfathering. Like any developer, you have a business case, you have a capital stack that supports that business case, and when a change is made suddenly, and like it at the very least, it's causing a delay in time. You've got to retool. Often now with the things like rental achievement and changes to the point systems, we have to go back and find more equity, and that's really hard to get right now. So that takes time. It puts projects at risk, and it just, again, it's moving goalposts, right? So I think that impact is hurting us. And then on the consultation piece, I think they seem to be good at consulting with lenders and facilitators and stuff like that. They've never consulted with us or any of our peers that I understand, and we're ultimately the end user of these programs. So, just devil's in the detail. I think if they want to get it right, that would help. Where the opportunities are, like, I'm not right now with these changes. I don't know if they've created much opportunity beyond what I talked about on maybe for buyers, and particularly first-time buyers. And so, again, if you're getting an insured mortgage, and now it can be up to 1.5, it really enables you to buy more. It helps affordability. Same with the longer amortization. So I think those things are good. I think like that's a step in the right direction. But as far as, their construction lending, I think if anything, opportunity has been sort of taken out of the program.
Mm-hmm.
I know we are looking way more at conventional debt on rental, and I've heard the same kind of nationwide.
Mm-hmm. No, absolutely. Yeah, and
it was certainly a curveball, I think, some of these CMHC changes, but at the same time, I think we're all still grateful that CMHC exists, right? Like
totally,
because we're often looking at the other asset classes that don't have a CMHC. Boy, the development situation's even worse there. As difficult as it is for housing, go look at the office or retail development market, and they'd be on their knees begging for CMHC to provide longer amortizations and some of this. So I share these concerns, but at the same time, it probably would be even worse without them, right? So
I do think, yeah, absolutely, and that's why I don't want to like they have been good for us, and I think they continue being. It's not like it's just disruption, and it's time, but I would agree. I would agree with that for sure.
Yeah. So we've just briefly touched there on other asset classes, Adam, and I think the thing is that if we take a look at it, there's certainly a number of challenges in just receiving any kind of capital out there. It's tight. Funding is tight. I know Anthem's been pretty creative with one project in particular in terms of raising capital. Can you share some of that with us?
Sure. Yeah. You guys said it. Going into other things, it's harder, right? And we can talk about why that is, but it's probably pretty self-explanatory. But I think in terms of creativity, I mean, yeah, like we have a big pipeline, and we're an operating business, and we don't have the luxury of stopping, so we got to deal with what comes. And so that means being creative, and often that means we're cutting more expensive deals for us, but that's still a far more optimal alternative than doing nothing. And so what you're referring to, that's our Citizen project, I believe, that you're referring to. It says in Burnaby. And that's when we had good line of sight. I think the construction debt there, we were able to get, but capitalizing it with equity was extremely challenging because, it's a bit of a Frankenstein project. It's got retail at grade, and then it's got 10 stories of hotel, and then it's got affordable rental, and then market rental, and then condo. The condo we had pre-sold really well, kind of at the back end of 2021, 2022. So we had that going for us. That was the construction debt. But again, equity, we needed over $80 million, and like there was just nothing out there. And so we were aware of the fact that CIBC had run these real estate development trusts, they're called, in the US. And essentially they just go out, it's like an IPO. There's a full prospectus, there's all that stuff, but it's tied to this one project. There's no real liquidity. Once your capital's in, it's not coming back out until the project's completed. But really, they're going out to their IA network, and it's almost at a retail level, although a lot of the investors, are writing $5 million checks, which is not really retail level. But we thought it was a really creative way to access sort of that capital that we had no access to. Like, we're not all over the country knowing every high net worth individual.
Yeah.
And so it took a lot of work and kind of working with them back and forth on structuring the deal and how it could work. But we got to, I think, a good solution with a preferred structure. And again, having the pre-sales help, and the hotel market's quite hot right now. And, that's maybe a silver lining in the Airbnb thing. And so we thought we'd try it out, and we went out, and it was success. Like, we raised the 82 million in just over a month, and now we're under construction, we're getting going. And so that was a huge bright light. And we've done that's the only one of those we've done, but we've done similar things with kind of private capital or private debt markets, where we've created products where, again, it's sort of a flat mid to high teens return. And, so we're taking the risk, and we're saying if things get better, we'll get paid on the back end, but at least we're going. And there's been a lot of high net worth money kind of filling that gap where banks and traditional sources of equity just aren't there right now.
And I would guess that got some happy shareholders of that too, or people who've invested with those kind of yields and with your track record reputation. So it's just a win-win, which is fantastic to hear.
Yeah, exactly. It's what's helped us to sort of grow over the last couple of years at a time when it's been really hard to do that.
Yeah, no, absolutely.
And I apologize. This wasn't on our script, but I'm curious if we could just get into the debt market mystery. To me is, this isn't exactly profound, but we've had 5 rate cuts, and yet when I look at the Canada mortgage bond, it isn't really any different than it was a year ago. It's maybe 0.1% different. Like, we've had 5 rate cuts, 2 jumbo rate cuts or double rate cuts or whatever we call them, and it just hasn't had any effect on borrowing costs. And I'm kind of at my wit's end of like, well, do we need 5 more cuts, or is there just no way that, like, I don't think it's realistic for debt to go back to 2021 levels, but what is it going to take to actually, like, get yields below 3% for a Canada mortgage bond, or is that just not in the cards for the next couple of years?
Great question. And that specifically affects debt tied to those bonds, but that's a lot of debt. Our sort of thesis is that the 5-year bond probably won't go much below 3. We're not counting on it. Like, in our view, that's the new normal, and it'll just sort of fluctuate. For it to go down, it'd probably take a tougher economic situation, which has its own repercussions, of course. But I just don't see it. There's just so much volatility, and so I just don't. I think that risk is being priced in, and so if we get a lot more stable, or things get worse, basically, I think that's what it'll take. And our productivity as a country is not good, as we know. So maybe that'll happen, but again, that's a double-edged sword. So we're just sort of we're kind of 3. I think the one bright light in that is that if you're talking about term debt on income property, spreads are compressing, which helps. Not everywhere, but for good assets, spreads are compressing. So getting a little bit of relief there, but that's about it.
Thanks. It's a constant point of discussion. We can't make heads or tails of it. Perhaps Tyler has some insight on this, but we're just stuck in the everything's priced in, everything is expected, no matter what we do. It's just meeting expectations, and at some point, we can't have 11 more cuts. That's not realistic. So at some point, we may just have to make it work in this debt environment. I think if you look, not that this is cold comfort for people, but if you look historically, 10 years, 20 years, I don't think our rates are crazy right now. It's just we're contending with the weaker currency, higher prices, all of these other things that are kind of pressing on it from other directions. Sorry, go ahead, Tyler. I'm sure you have something
absolutely.
to say here.
No, I'm on side with Jordan. I think 3% is kind of where we're going to see it. Particularly, there's so much volatility in the market from every side right now that I think that's why it'll hold. But the spreads are where we'll see the compression. The banks hopefully being a little more conservative this year as loans pay down and capital's freed up, and they're competing, which
exactly
seems to be starting. That's for sure.
Absolutely. I can tell you, like a grocery anchored shopping center, for instance, a year ago the spread was 250 basis points, and now it can be as low as 130 if it's really good, up to 180. So that helps for sure.
Yeah, and that brings us back to kind of where that pricing was a few years back too, in terms of the spreads.
Yeah.
Which helps you be a little more competitive in the marketplace and free up a bit of cash flow.
Exactly.
Okay. So talk to us more about the development market. Like everything has been a yo-yo since COVID, return to office, interest rates, inflation, everything. And I would say development falls into that area. Also, 3-4 years ago, we're saying all-time record high levels of development. Now, for some other assets, we're talking about literally zero development. Like you guys are in the middle, you have a desirable asset, you have a desirable market, but restrictions on capital, like upside, downside, what are you seeing on the residential development side or the other assets?
It just in terms of restrictions on capital.
Yeah, and just like the outlook for borrowing and development generally. I mean, I think development is just getting harder and harder. In every area, in the approvals area, in the lending area, in the construction costs area, but like there has to be some light at the end of the tunnel here. I hope you can tell us there is. So
yeah, no, I think I do think so. Like I think we have been held back by supply creation has been held back by restrictions in capital for sure, and some of that's just because the economics don't work, and so no one's going to like neither we as a sponsor of a project or our partner, whether that's debt or equity, you're not going to invest kind of knowing you're not going to be adequately compensated. And then the other side of it though is there are projects that work. Like we have a lot of projects in our pipeline that we're showing pretty good returns, but it's still really hard to get the capital. And on the debt side, I mean, we're lucky that we've been around for a long time, borrowing lots of money, paying it back. We have a track record. We're considered a tier 1 borrower, which helps, access to preferential rates and sort of reception to our, ideas. And I think, it's really helped having a big income property portfolio just because, our lenders know there's cash coming in every month. We're not just sitting there kind of burning through it. But it has been challenging. And then the equity side, it's been really challenging, right? Because again, same reason, people have uncertainty. They're not, there's just sort of a risk off mentality, but also a lot of the big investors, whether it's a pension fund or it's a big fund made up of pension fund money, they've been hammered, whether that's through redemptions in an open-ended fund or their allocations are off. But like we have had hundreds, and I'm not exaggerating, conversations over last year where it's just sort of like we're not in a place to invest right now. So it's slowed us down. Like we could be creating supply and we're just focused on capital formation. We're though, like I do think for sure I think banks are getting more comfortable. They're feeling a little better. They seem to be out there more. I think the institutions and that kind of capital, I do see them getting through their issues because like I said, we're having a lot of conversation. A lot of groups the last year couldn't do things, we're in active talks or we're working on JVs with them. They seem to have they've gotten through the worst of it. And so I do think we've kind of bottomed out and there will be more capital returning to the system. You'll see activity pick up and that'll be a good thing. So I'm feeling like way better. We are Anthem. There's way more kind of working in our favor. But to your point, Adam, it's not like it's blue skies. There's still a ton of challenges, and that's why we're so focused on just our organization and being able to respond to these quickly and intelligently.
Yeah, I mean, clearly the worst is over. I don't think anybody, as bad as it is, I don't think anybody's talking about hiking rates or any of those kind of, there's still some easing coming. The question is just like, we've had a fair bit of easing and like, it just hasn't quite had some of the effects that we hoped, but it still could. And, the conversation is obviously complicated now by tariffs and the U.S. and the Canadian dollar and the Liberal leadership and 100 other things that are a little bit beyond the scope of this podcast to analyze. But it does seem like political risk or whatever you want to call it plays perhaps a larger role than it did maybe like even 3 years ago or something.
Absolutely. Yeah, to me, that's the biggest one is the political risk. It's a constant. Yeah.
Yeah. I mean, I think we'll have some clarity. I like to think that 6 months from now, at least it'll be clearer one way or the other. It might be negative, but at least we're just completely in limbo now. I get questions all the time about are tariffs going to apply to lumber versus oil versus auto? Like nobody knows. This is all just speculation, and we're going to have to get some clarity here.
Exactly. Yeah.
Let's return to our topic at hand. I have little to add to the political analysis, but like you mentioned this earlier, but like the pre-sale market. I mean, for years and years and years, the pre-sale market was kind of bulletproof. Like there wasn't necessarily like a huge obstacle to getting buyers. It made sense on the buyer side where you're not committing a lot and you have a rising asset that's probably going to be delivered at a price that you're happy with. But that's kind of broken a little bit. Like how is it playing out locally in BC in the lower mainland? I don't want to be too negative. It's just like clearly there's been some shift in that market, whether it's just psychological and sentiment or whether it's dollars and cents.
Yep. Yeah. No, you're right. And I don't because historically it's exactly as you said. I think it was you can't take anything for granted, but it's a pretty safe bet. You put in a little bit of money, it's going to go up in value. And before you had latitude, you could flip it, you could rent it, you could do whatever. And there was there was less restrictions on that, if we're talking about foreign cap or whatever, which did, I don't think it was like, it's been very vilified. Speculators were driving you out of affordability, blah, blah, blah. But at the same time, that money and those deposits, translates into equity that helps you get the thing built. It often creates rental stock, again, we keep coming back to politics, but there's just been so many demand side measures, which has made it harder for people. It's harder for foreign capital to come in and invest in that without being taxed heavily. Affordability's really deteriorated. So even if people are willing to buy, they just can't. And then of course, with all the uncertainty, it's like, am I going to make money on this? It's not as certain as it used to be. And so there's just this hesitation. And I think, I don't know, I'm not seeing anything in the future that's causing me to say, we're going to come back to this roaring, let's sell out 300 units in a weekend type of environment. Like a lot of things have to change for that to happen. And I think it'll return to this, a little more gradual. And I think maybe that's okay because not totally okay, but there is a lot less supply and a lot of there's a lot of players in the market are now out of the market, which is not good for them and it's not good for the overall health of things. But there's less availability and there's less options, and so it is being consolidated a little more into, I'd say, the more established developers. And so, I just think we're going to be I think we'll hit our even over the last couple of years, we sold 1,000 homes last year. It's not nothing. We're getting there. And I think that'll increase a little bit again as interest rates come off and the CMHC programs help and people get a little more confidence back. But it'll take us a little while to get there. As I said, we've got to chew through inventory.
That's it. It's just a different race now.
It's a different race now, totally.
It's a marathon, not the sprint like we had before.
Yeah.
So it's just a matter of seeing it evolve. So that just leads me to something else, Jordan. I know you've explored this market. And I know we've seen a lot of headlines about it, and that's office conversion.
Yeah.
We've had this discussion. I know many of the people listening to this who are developers or in this business know that math doesn't always work. Can you just glean on that a bit? Where have you seen the opportunities? And,
for office
and why
conversion?
is it so tough? Yeah, like Calgary, I know you've touched.
Yeah,
the city's been very, very favorable to developers there as well.
Yeah, yeah, and you can buy that office for super cheap, right? But it's a real thing, and I think it's positive. But I think, like you touched on it, it's way easier said than done. You can't just say, well, we've got a bunch of empty office buildings and we'll make them rental and housing crisis solved. And it just comes down to economics. And a lot of we've done one office conversion a long time ago before it was palatable. But the building sort of has to work for it, right? You have to be able to make units that people are going to want to rent or buy, and to the extent that the units aren't optimal, it hits your pricing, right? And so the economics, again, it doesn't really work. So it's sort of a case by case thing to me. and especially if you want top, like people now, the market expects good product. They want like very efficient, functional space, good amenities. And so it really just comes down to a pro forma exercise. Can you convert that office building in a way that you're going to be able to get the revenue? And obviously the cost needs to make sense. And so it's just something you got to look at carefully. And we look at those opportunities regularly. We actually looked at one in your market in Victoria. Yeah. And we just didn't really have a willing vendor because it would have implied a bit of a write down. And so, I think it's a really cool opportunity. Again, I just think it's easier said than done. And you got to kind of know what you're doing.
That's just it. I think one word you hit there was write down. And I think that's important for most to remember, because all of a sudden you're dealing with a different code. You're bringing in more utilities, bathrooms, toilets. The floor plates may change, elevators, everything. So really at the end of the day, what does the price look like just to get started, let alone do all that remediation, whether it's asbestos or what have you.
Exactly.
So it's an incredible undertaking.
I always say I wish it were easier. Like you read the newspaper, it's presented as this completely obvious solution. Like, well, there's too much office and not enough housing. I mean, what are we doing? This is so obvious. And then you talk to anybody on the engineering, development, consulting side, and they're like, well, there's 200 things that might not work, and the windows don't open, and how strong is the floor and the ventilation, and like it's just I really wish it were a simpler solution to all of our problems. But outside of like Calgary I give Calgary a lot of credit for their
absolutely
like putting their money where their mouth is, right? But I have a hard time seeing it happening elsewhere. Many things are possible when you're being paid by the square foot to convert things, but that's just not politically viable most places. Like, whether we like it or not, like a subsidy program like that isn't always going to be received well or seen as a priority. So I think Calgary's kind of an extreme case, and I think they've done great, but it's also like it's kind of hard to. Like, I just can't see that happening in BC for a long time for a variety of reasons, but perhaps I could be wrong on that.
I think you nailed it, right? Like, I think it is about incentivizing, and I think Calgary did do a really good job of that. And it took them a while to get there, right? Like that office market has been absolutely in the tubes for a decade. Yes. And it took them a while to get there. And then, of course, a lot of people started moving there, so it kind of worked. But I think in BC for it to work, or probably Ontario, you would need to see some sort of incentive, which we just don't get a lot of in our business relative to other sectors, right? So it's possible for sure, but you're right. There need to be political will there, and I don't know we'll see that. But again, case by case, you got to look, because sometimes it does work, and it can be a really good thing.
It's just a different reality. At 10% vacancy in Vancouver, nobody's seeing this as a burning issue. Like you say, a decade at 30% vacancy, and you start wondering if it's just a good investment to do this. Like you have to reach that point of you don't feel like things are going to just turn around organically, and I don't think most cities are there. Certainly not in BC. I mean, we were just looking at all the leasing stats, and certainly, though it may seem painful there, the office leasing situation in BC is far better than it is anywhere else in the country. It's not as overbuilt. Rents are higher. Vacancies are lower. Like, I know it's not what it was 5 years ago, but it's still a much better situation than most of Canada.
Yeah, I concur with that for sure. Yeah.
Well, we don't want to get too political, but we referred to this earlier, which is the Airbnb situation. There is a connection between all of these things: pre-sale purchases, foreign investors, and then Airbnb sometimes being the end point of, especially like small floor plate, micro condo, whatever you want to call them. There's restrictions against Airbnb in BC, as I said, in lots of other places. Like, can you tie that to, is it actually impacting the business? Is it just, people move on and they change what they're looking for? Has that cut out part of the market? Like, how do you see that playing out?
Yeah, I think so. And like, I think it's probably more pronounced in a market like downtown Victoria, just where there's not a lot of hotels, and it makes sense as a business model. And here it's tough because we don't, a lot of buyers don't advertise, I'm doing this to do an Airbnb. And so we don't have the exact data there. It would depend on the location and the projects. I mean, we do have way more product, I'd say, through Lower Mainland. It's neighborhoody, and it's serving people who will live there. And so I don't know that the impact is as profound, but certainly where you have smaller condo units, on transit or in attractive locations, that's taken a segment of buyers out of the market. And I have friends, brokers in the community that was a side business for them, right? They'd buy pre-sales, they'd Airbnb it, and now they're kind of stuck holding these units as rental, and they're not making a return. They're certainly not going to do it again. And so that's anecdotal, but I'd be reluctant to say it's having a profound impact. I think there's just there's a ton of variables kind of putting us in the situation we are right now, and it's hard to delineate each one based on the data we have. But yeah, so kind of a non-answer. But I think it's had an impact for sure. It depends on the location, depends on the project, but I don't think it's the reason pre-sales are necessarily stalled right now.
Yeah, Jordan, you're right. There's so many different things. We're in a perfect storm. In reality, we've got higher interest rates, although those are easing. Airbnb, restrictions on foreign capital, anti-flipping, rising construction costs, although they're starting to stabilize, shortage in labor in some areas. So when you put all that together, yeah, absolutely, you're right. There's just too many factors to point at one, I would presume.
I agree.
Exactly.
Can I follow up a little? Like one story, it's on my mind because it was on the front page of the Toronto Star today, which is some developers are swinging a little bit back towards, okay, micro condos. If we don't have Airbnb, then 380 square foot condos are not of interest to most people. We're going to go the other direction. We're going to start building 3 bedrooms with amenities. We're going to there's been such a downward pressure. We have some data on this that, the average unit size has gone down 40, 50, 60% in some markets. Do you see any kind of path? I'm always it's hard to see the path for the average unit size to get bigger, but if that's what the pre-sale buyer or the end user wants, then maybe it will go that way, even with interest rates and construction costs and everything. What's your view on that? Do you see any pressure to bigger units, more 2 and 3 bedrooms?
Yeah, I think, I would say the market's going that way, and I would say just policy is going that way, right? We're often dictated there has to be a certain number of 2 bedrooms and 3 bedrooms, and so you're right. I think for rental, a small 1 bedroom is so good. But I'd say on the pre-sale side, you're right. Those very, and we've had a few projects like that one in Surrey where the 1 bedrooms or studios are quite small. I think they're still good for a pre-sale investor who wants to rent because they can drive the price per square foot up, and renters are a little less sensitive to that kind of thing, particularly if it's just a short-term gig for them, a year or two. But I think in certain locations, where I'll say downtown, where you might be more inclined to try to get that Airbnb kind of buyer, and there's more reasons for tourists to want to be there. Yeah, I think you're probably going to take a bit of a hit on revenue with the bigger units, but it's less costly to build at the end of the day, and so that's good. So I think you're right. We'll probably see less of the micro unit thing. I don't think a 1 bedrooms, unless it's a kind of luxury or boutique neighborhoody product, I don't think you'll see 1 bedrooms going too much above 600 square feet or 550. I'm not seeing any proof of that, but there are more 2 beds, there's more 3 beds for sure. So I think, I don't see it getting smaller. I don't see it getting too much bigger, but we'll see. But I like more of what will be built will probably be targeting that end user, which would imply a higher unit or a larger unit.
Okay. I've really enjoyed this discussion. Thank you to Tyler and Jordan, of course, for joining us. This is the Colliers Talks podcast. You can reach out to any of us if you enjoyed this, if you want to talk more, if you want to get some data from us. Thank you to the audience. We always appreciate you tuning in. And I'm looking forward to the next episode. Thanks again, Jordan.
Yeah, thanks so much, guys. Appreciate it.
Thanks, Jordan.
Thanks for listening to Colliers Talks podcast. To learn more about Colliers Canada, our experts, and our solutions, visit collierscanada.com or find us on LinkedIn, Twitter, and Facebook.